Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, Kevin, good morning and welcome to the Pilot Money Guys, Flight 112, How Not to Run Out of Money in Retirement.
Sounds a little negative, Charlie.
I know it's finally a very exciting topic, right?
Yeah, no, this one is great. I mean, this one is fantastic. This is a part of what we do every day. And you only get one shot at retirement, Charlie. If you mess it up, you messed it up. Oh, well.
This is what it's all about. You know, all the stuff we've talked about before, Social Security, long-term care, all this stuff is really about this. What's our retirement going to look like? Can we spend the amount of money we want to spend? Have a good life, have a good quality of life. So we're going to talk about that today, Kevin. We're going to give several helpful nuggets on things that you can do if you're a do-it-yourselfer. We're going to give you some tips today, maybe some useful links and websites to help with that. We're also going to talk about some of the things that you and I have learned that could be helpful to everyone, whether you decide to do it yourself or you're a delegator, like probably half of our audience, probably split down the middle, I would say. But nonetheless, first, we're going to start off with some questions from the flight deck. And we know it is open enrollment season, so we're going to jump right in. By the way, I forgot, please take the Pilot Wealth Index. That's going to be on there as well. Thank you for those that are doing that. The response has been awesome. And please give us a rating and review wherever you're listening to your podcast. It's super helpful. So thanks for doing that as well. And we appreciate it. But first, Kevin, questions from the flight deck. Open enrollment's coming up. Let's talk real quickly about, and again, I know it's all airlines, so we'll try to just hit some highlights, but just some trends that we see as it pertains to people taking advantage of their airline benefits. And Kevin, I'll start with you. If anything top of mind for you as far as what you've seen lately, what you've learned lately about any benefits that have made an impression on you.
Well, to take a step back, Charlie, how are benefits usually chosen? It's usually chosen that someone comes home and says, honey, we got to do this. The other person goes, Yeah. So you open stuff up and you start looking at it and you haven't thought much about it. So maybe that's not our audience, Charlie. I'm sure that's not our audience, but that happens with a lot of families. So I think going in with some ideas is really the way to do it, as opposed to, should we choose A or B here?
Absolutely. Yeah. And it's hard because there's a lot of moving parts. There's a lot of, I remember sitting there and all of the pilots I know are the same. You sit there as a brand new hire the first time you sign up for these things, and it's like a different language. Plus you're trying to learn how to fly an airplane. But, you know, as you become more senior and you get faced with this every year, you get a little bit better feel for things. But yeah, there's some great benefits. The airlines, like no other, Kevin, I've never seen any other industry. We've worked with other people. These benefits are just incredible.
Yeah, it's impossible not to complain, Charlie, as you know. It's impossible. And there's always some reason to be, there's always some reason to be like, hey, they have better benefits than we do. Our union stinks, whatever. I mean, those are always parts of it. Yeah. But, you know, I think the biggest evolution for me, Charlie, is with the GVUL, which sounds super boring. It kind of is super boring. They try to make it sexy by saying you can invest in it. But the GVUL, at least with Delta, it's almost a no-brainer. Actually, I'll say it is a no-brainer, Charlie. The first time I've ever said that, it's a no-brainer. If you use the GVUL versus the term, you have less imputed income with the GVUL. There is a little complexity with it. Someone may call you and ask you if you want to invest some of your money in a GVUL because it's absolutely the perfect vehicle. Untrue. But, you know, we're going to be really studying the GVUL for all the airlines this year, Charlie, because, again, whatever the tax rule is that makes it have less income on your paycheck, also known as imputed income, it actually has better rules than term policies. And at least one airline, Charlie, Delta, is actually paying for the benefit and you get less imputed income.
Yeah, absolutely. And Delta's union, I think, did a good job, or they're on the podcast about why there's less imputed income. I'm not going to try to repeat that because it's IRS code this, IRS code that, whatever. But the point is, when you get insurance through your employer, there has to be imputed income that you will pay tax on. And Delta has offered it as the primary insurance. So therefore, Delta pilots are paying less tax on that imputed income for reasons that we don't
we don't want to get into.
Yeah, tax code.
I don't know if I understand it or not, but
Exactly.
here's really the bottom line. We talked to someone from Delta, and only about 40% of the pilots had taken it. GVUL is portable; you can take it with you. There's a lot of good things about it, and Delta really pushed forward and got a great benefit there. The other airlines, we're not so sure. It's more of an extra type benefit. We believe with all the airlines, we're going to be going through some heavy duty training internally to learn all the nuances, Charlie. But yeah, I mean, I think that's the first thing I look at with benefits is what are your risks? And one of the risks is dying. One of the risks is disability. One of the risks is having to go to the doctor or some type of surgery or something. And I don't know, what are the other risks? Non-rev flighting? I don't know. What are the other risks that you can think of?
Yeah, you nailed it. The disability, I think, is the biggest for pilots for sure, due to the nature of that FAA medical. But yeah, the GVUL, did we say Group Variable Universal Life? I'm not sure if we even spelled that out yet, but yeah. Southwest has it. United has it. It's a little different at each airline, but I like what you said, Kevin. The beauty or the benefit there could be that you decide that you want to continue with life insurance after you're 65. Most people probably don't need life insurance, but there are some circumstances where you're like, hey, it'd be nice to continue this life insurance policy. You do have that option with the GVUL. So that's kind of nice if it applies.
Yeah, absolutely. So we're going to be coming out with a number of educational resources. Hint, hint, subscribe to our YouTube channel or just stay tuned on the podcast here. We're going to try to really hit all the benefits this year, Charlie, as before the window's open, we hope. But we know how things go with that. The other thing that's really big as we come up on December is just that the choices you make more so than ever with your 401k not only affect your 401k, but also affect your market-based cash balance plan. We used to just think of it as a spill cash decision, but things have changed there, more to follow.
Yeah, and American, I think, just got their market-based cash balance plan approved. We're still waiting for Southwest to get their spill cash thing approved. That's probably not going to happen in 26 like we originally thought, but that's okay. And I think
it might.
It might. That'd be nice. You never know.
Yeah.
And United's, we're still waiting on their market-based cash balance plan. So there's going to be, when that becomes available, there'll be some more choices that, especially at United and Southwest, that they need to think about and have a plan for. Otherwise, something unexpected might happen that you're not so happy with. But anyway.
Yeah, and the United pilots, just to be fair, they did vote down the new plan that came out, so they've gone back to the drawing board to try to get it up and running.
Yeah, excellent. Hey, Kevin, one last thing on the benefits that I see is, in general, we see a lot of, I'll say, young families. When I look at life insurance, we do our life insurance analysis for families. I think the most vulnerable is a young pilot airline family with young kids, because you have so much earning potential ahead of you and you have young children. And so let's say you have a stay-at-home spouse, then you are in the situation where you need the most life insurance in general. And I consistently see a little bit lower life insurance, I think, than we probably should. And I know that's hard to address sometimes, but I just like to throw that in general. If you have a young family, young kids, you got a long time horizon in the airlines, think about life insurance a little bit more and maybe get some more.
Yeah. I mean, the disability now with the new contracts that came out, no longer new, but it fixed a lot of the disability, real concerns that we had. But yeah, the life insurance, the youngest people with the youngest families have the most to lose. Future value of a pilot might be $5, $6, $7 million. And, you're insuring 500, 800. It might not be enough. And so we do not sell insurance, Charlie, I'm happy to say, but we are fiduciaries and happy to talk about the needs.
Yeah. And at each airline, there are usually great opportunities to get lots of life insurance. And I think with the new contracts, it's all portable now, which is phenomenal. So great opportunities there, but don't skimp on life insurance. That's a tough one. We've seen how that plays out sometimes.
Yes.
All right, Kevin, let's jump in. How to not run out of money in retirement. That's our headline. We're going to jump into some nuggets here, but first of all, Kevin, I Googled this. All right, I'm just going to Google how not to run out of money in retirement, right? It sounds like a great headline. I've got a few results, 14.2 million.
I thought you AI'd it. I didn't think you
I did
Googled
that
it.
too. I Googled it and
Oh,
AI'd it.
okay. Thank you.
Because I was like, okay, if I'm doing this myself, a lot of people listen, we're not here just to push our services, Kevin, and we want to help people. We love working with people. We're happy to do that if somebody is a delegator. But sometimes people are like, I'm going to do this myself. So I'm like, what would I do? Well, first of all, I'm going to Google it. Okay, 14
Yeah.
million results. Then I'm going to go to AI, and AI says, here's some starting points. Here's some good techniques. Here's some things to think about. Retirement spending is not linear. Plan spending smile, if you know what that is. Personalized calculations and ongoing adjustments are the best way to ensure sustainability. So there you go. AI has solved the
Yeah.
problem.
So people don't have to Google the retirement smile, Charlie. It just means like if you look at a smile, it's on one end, you're up, on the other end, you're up, and then your mouth is down. And what that really means is you spend more at the beginning and you spend more at the end because of health issues. In the middle, you usually spend less, also known as the slow go
Yeah.
years.
Slow. What is it? Go,
Go,
slow,
go.
and then no go, right? No
That's
go.
right. No go at the end.
I
Yep.
think no go means we're dead. So,
Well, the final no go does, but there's some time in between the slow go and the no go where you spend a lot of money,
yep.
unfortunately. And why am I laughing? I don't know.
It's exciting. Hey, you're almost there. That's why you're laughing.
Yes, I
You're
am. I
supposed to
am.
go.
Yes, I'm absolutely thinking about retirement income, Charlie.
Absolutely, man.
Thank you. Thank you
Yeah.
again for reminding me of my age.
Absolutely. All right. So here we go. What do people want to know, Kevin? Most people want to know, just tell me how much I can spend in retirement without having to worry about running out of money. Right. That's what people want to know. The second
Yep.
thing I think they want to know, back to that retirement smile, is how can I maximize my spending when I'm the most active right after retirement? I don't know, whether that first 10, 15, perhaps years of retirement, how can I do the things I want to do, maybe in anticipation of slowing down a little bit? I say maybe because we really don't know. We've got some people that are in their 90s traveling, late 80s and 90s, still doing some stuff, right? Not many, but some.
Yeah. Jack Gormley, 89. My dad
There you
played
go.
golf with him. He beat me twice. Yeah, it's possible.
Absolutely. So you and I take it a step further, and we think a lot of things about how can we take money or retirement distributions out tax efficiently. There's a lot of value that could be potentially had there, whether you decide to do that yourself or not. We think about Roth conversions in retirement. We think about optimizing Social Security. Refer to Flight 111 that we did a couple weeks ago. That has a big impact, Kevin, on how I take retirement income and how much, quite frankly.
Yes, yes. So, and here's the issue. I guess here's the rub, Charlie, is that you spend all your time working, and everyone's talking about how to build the biggest retirement nest egg, and that's what you do, and you learn how to do it, and you do it pretty well. You can do it on your own. You really can. But then when you get to retirement, all of a sudden it's like you're no longer doing what you know, and you're doing something totally different now. And there's so many variables. That's the problem. So if we knew how long you're going to live, and we knew that you just had one type of asset that you could take out, Charlie, and you have no choice, or if you have a pension, like in the old days, it used to be pretty simple to think about it. But now there's math involved, and then there's also an art form involved because we don't know how long we're going to live. If you spend too much in the first year, that might be okay with a retirement smile. But wait a second, you went over the 4% rule. And so there's all these conflicting ideas out there. I don't know how many 14 million you did on Google. I don't think there's 14 million ideas about this, but I think there's a lot of ideas. And what we see sometimes is we get sent an article by one of our clients that says, "What about this?" And it's like, yeah, really, that came in from left field, that idea, and it's true, or it's BS.
Right.
So that's what makes it kind of difficult. The art part is what makes it difficult. The math is pretty easy, Charlie.
Totally agree. And when I did that Google search, by the way, the first 20 were advertisements. The first 10 of those were probably somebody trying to sell you something. So it's really challenging. And today we're going to talk about some sources and some reliable links. We'll provide that in the show notes. You can email us for some more details if you want, but I'll talk specifically about reliable sources that you can go to. Kevin, the other thing that we think about is, hey, what if we retire and it's 2022 when bonds had their worst year ever? 2008 stock market, we had pilots retiring at age 60 into the worst recession we've had since the Great Depression. So what do you do And you're right. Sometimes a 4% rule is a good rule of thumb, but it doesn't really apply to each and every year of our lives. So that's what I just mentioned there is sequence of return risk. But so Kevin, key things we'll be addressing today: 4% rule, dynamic spending, 3-bucket strategy, just fixed spending, perhaps, whatever strategies are out there. We'll talk pros and cons really quickly. And then we'll talk about what are the steps that you need to do to get ready for retirement spending, such as know how much you're going to spend. What is it that you want to do, and put price tags on it. So let's jump in, Kevin. But anything else to add context before we jump into these withdrawal strategies?
Yeah, so the only thing I'll say is that many people, they do their work life and they work for a number of years, and then they start, and I've gotten invited to a lot of dinners once I went over 55. So yeah, for a lot of years. Okay, Charlie. But you get invited to these dinners. That's absolutely not the place to learn about retirement income, because I'll say 99%, but maybe it's not 99, maybe it's 90% of the time. It's insurance people. And they only have one solution to the problem. And that's not what you want, Charlie. You want some thoughtful, critical thinking about all the issues, emotional and otherwise. And the insurance people, they got a job to do. I get it. Yeah. They're not evil. But what they're going to do is scare the whatever out of you. And the solution is going to be an annuity. And although we'll talk about annuities, and we like annuities for certain situations, we absolutely do, and we've used them. They're not the solution for everybody and for all your money, Charlie.
Exactly right. And I'll just shed some light on that, because that's important, Kevin. We joke a lot about, and I'm looking forward to getting those steak dinner invitations, because it's a free steak dinner, by the way.
Yeah. Is anything really free, Charlie? Is it really free?
You go to Ruth Chris and get your free steak dinner. But, and like you said, we're not going to bash on other professionals. But what happens, and I was on that side, and I tried to put together something like that when I was first starting out. But what happens is you put together the free steak dinner, but you can't afford the free steak dinner for 30 people. So you get an insurance company that sells annuities to come in and pay for it for you. You sell your services, which is great and honorable. And then the insurance company says, "Hey, look, we paid for this dinner. We're going to give our pitch here, and we're going to hopefully sell some annuities to pay for this dinner." Again, none of that is wrong in and of itself. Go get your steak dinner. But like you said, you nailed it. There's not a place to learn about retirement, and annuities are not a sole source solution for retirement. We're going to talk to a couple of those in a minute, but yeah, and we'll also share some reliable sources, like I said before. But Kevin, can you start us off with the most common, the most well-known? If I'm just entering retirement myself, man, I'll just use 4% rule. It's talked about enough. I think it should be good.
Yeah. So what is the 4% rule? That's really the important thing, is because these rules get made into gospel, and really what they are is usually a study that was done, and people that, and we do it too. You hijack things to make it simple to understand. So that's what a rule of thumb is, obviously. Make it simple to understand. So you're pulling it up there, Charlie?
Yeah, I've got it. Yeah, we got some good rules here as far as,
just bear with me for a second. This might be boring, but if you're going to use the 4% rule, you need to be bored. So anyway, Bill Bangan was the person that came up with this rule, and he did a study from, people retiring 1926 to the mid 70s, and he tracked 30-year time periods and what was the worst case scenario. And by the way, Charlie, Bill Bangan is still living. He just did a podcast with Ben Carlson. After you're done with this, of course, if you want to go and go to YouTube, and you can hear it directly from Bill. But basically, even the Great Depression was looked at. The 1970s were terrible. The year to retire that was the worst was somewhere 66, 67, 68. I don't know the exact year. I know it's close to my birth year. But anyway, and they used a 50-50 portfolio, stocks and bonds, very simple portfolio. During that 30-year time horizon, it assumes you need your savings to last about 30 years, and that means you're retiring at 65. If you live to 95, this rule worked in the past. And really, Charlie, the most important thing is this is about the past. This is not something that might happen in the future. But they said, okay, day one, let's just say I'm going to take out $50,000 on day one. Next year, I take out $50,000 plus the inflation rate. The year after, I take that second year's plus the inflation rate. And that's how it went. And so, Yes, it worked in the United States, and that's why we got the 4% rules. Actually, I think 4.6 something, Charlie, if I'm not mistaken, or 4.5 something. But the problem with this 4% rule is this only worked for people that retired in the United States during these years. It did not work for all countries around the world. The United States stock market did well. We did have massive inflation in the 70s. It still worked. So that's really good. And so it does tell us what happened in the past. And I think it's a pretty good start, Charlie. What do you think?
Yeah, I think what I think about as you're talking, I think about an article I just read by Morningstar that said, oh, it's 3.7. And then another, I think Bill's most recent research is, oh, it's 4.7. And then I think, well, what if I'm 70? Then, or what if I don't have the life expectancy of 30 years?
Son of a gun, Charlie. You're ruining the rule.
I know. And then what if I need a new roof? How do I adjust the next year? So it's almost like a rule of thumb is a good thing to think about, but it's not a good thing to use, which is almost a paradox to me to think like it's a good rule of thumb, but don't use it. But barring any other strategies, I guess you kind of have to. And I'll be honest, like when we run our dynamic strategies, we look and we go, oh, it does kind of bounce around the 4%. Some years it's higher, some years it's a little lower, but nonetheless, that's, we do that a little differently. So those are things I think about there.
Yeah, to follow up, Charlie, it's one data point, and it's important. It's an important data point to us as financial planners. It just can't drive all behavior, and because the world is dynamic. The things that happen are dynamic. We just read a book called Armageddon. That's in the book title, and he recommends the author 2 to 3% is the way not to run out of money. So again, when we have a really couple bad years like we had in 2008, people were starting to say it should be 3%.
Yeah.
But I don't know. Did you look at the 2008 going forward, Charlie, if it's still been okay? I mean, I've seen data that says, 2008 was massively bad. And for 3 years, you suffered silently in your house, curled up in the corner on your linoleum floor with a bottle of bourbon by your side, and you worried. But I think the markets have come back so spectacularly that if you did spend 4%, I think you would be okay. But I don't have the hard math there.
Yeah, I don't either. And so it's so dynamic. Life is just so different, than that. Plus, what if you wanted to maximize, like we talked about, this retirement smile? How do I have higher spending the first 10 years of my retirement with the 4% rule and then lower spending the last? So anyway, those are some difficult things to think about if otherwise. But Kevin, anything else on the 4% rule before we jump a couple other strategies?
Yeah, I'll just say this, Charlie. If you're spending 8% of your money per year,
there you go.
You really could be in trouble. And that's really how we use the 4% rule.
Yes.
We'll tell a client, you can have 1 or 2 years where you spend a lot because that's life. But if you have an unexpected surprise every year, like, the new Porsche Cayenne just came out, that can be a very unexpected surprise. And I need to get one. If you have that every year, then it starts to really scare us.
Absolutely. That's the truth. Kevin, a couple other strategies. Pick your poison here. And interest dividends only is one that I think is probably still hanging on from the old days of blue chip dividend stocks, and whatnot. We can talk to that. There's bucket strategies, spending that you can Google or go to AI and learn how to do. And then there's the dynamic spending guardrails, which is probably closer to what we would actually do. But what are your thoughts on any of those, Kevin?
Yeah, the interest and dividend one was a real strategy for a number of years when there was interest and dividends that were a percentage that were high enough to live off of. 10 years ago, we saw interest rates go down near zero. I don't know how many years ago it was now, but anyway, so you would need like $5 million to live off the interest. And then the thing with dividends and stocks, that can work too. But if you've only owned all the dividend payers over the last 10 years, you've been slightly disappointed by not owning some of the companies that have screamed higher that don't pay dividends. And so if you live off dividends or you live off capital gains, Charlie, because the stocks have gone up, the math is pretty much the same. Mm-hmm. But there's a feel good around like, hey, I'm not spending any principal. And it's not always the best strategy, in my opinion. What do you think, Charlie? I
want to foot stomp, as we say sometimes, what you just said there, because there is this, how do I explain it? There's a really emotional, great feeling of, man, I'm just living off of dividends. Because I think our grandparents did that. And we go, hey, my parents and grandparents did this dividend thing. I want to do it. And I think it's also safe to say that the times have changed as far as that dynamic is concerned. But that doesn't matter as much. The most important thing is what you said there. Dividends and capital gains, virtually exactly the same. You can create your own dividends if you want to. It doesn't have to be a dividend. You could buy a stock, a company, or own a company, preferably be an exchange traded fund or mutual fund that doesn't pay any dividends, but it produces capital gains, which is going to be the same tax situations, same. So don't fall in love with the dividend strategy. To me, that's a little bit of a clickbait kind of thing. You can do it multiple different ways. So that's my little pitch on that strategy anyway.
Yeah, it feels good. Dividends have been cut a couple of times in history. Great Depression, Great Recession. Not a ton, but in the Great Depression, they got cut pretty good, but they still were paying out a goodly amount. But right now, I don't know what the dividends are on the S&P 500. I'm going to guess 1.3, and everyone can laugh at me if I'm way off base. But it's hard to live off of 1.3%.
Yeah, absolutely. And so, like we said, the capital gains essentially is very similar, and there can be some misleading headlines about dividends or interest. I've seen before in the world of oil and gas, Kevin, like we pay 10% annualized interest, or 15 even, or yield. They'll say yield to make it look good. And all the while, that investment could go down 20%. And so it's a total return that we're after, not necessarily a yield or a dividend payment per se. But Kevin, let's say
I got something else there, Charlie.
Yeah, hit it.
Yeah. So first of all, the dividend rate is 1.25. So I wasn't too far off. That's good. That makes me feel good. I still have my brain, at least some of it. But there's also these new products, Charlie, that you can create dividends out of non-dividend paying stocks. JEPI is probably the biggest. So what these products are doing is they're using options to create actual income. And what you just said is the truth about that. So you can get a 10% dividend. Hey, I can live off of that. Yeah, absolutely. The problem is if the investment goes down, you're really taking the money out of your gains in the long run. And if you don't have gains for a long period of time, the value of your investment will go down. Although the dividends will keep coming, you'll have less money.
Yeah. So that can be a little confusing to people that, hey, let's just do this sexy dividend strategy only. So, but bucket strategies. All right, we got a couple more we're going to talk to, and then we'll kind of summarize, some potential strategies. But a bucket strategy tends to be one that we like. Although I still think you need to have some kind of indication of how much I'm going to pull out of my portfolio. That's still a basic principle. The bucket strategy to me is just maybe how we execute this plan, but the bucket strategy is basically you can literally segregate your accounts. Open up even a bank account, a high yield checking account, a brokerage account, probably an IRA. The majority of our folks, our people and ourselves have IRAs. That's going to be the majority of our monies, or 401ks. So the idea, Kevin, is that I have a checking account, savings account, or maybe even a brokerage, high yield investments, treasury bills. They're going to provide for my first year and a half it's going to be cash-like investments. So first year and a half, maybe 2 years of spending. Second bucket could be some shorter term bonds that have a little bit of interest payout. And then the third bucket is most likely going to be the majority of your equities or stock funds, if you will. And this really, to me, is more of a behavioral strategy, which is very powerful, by the way. We've seen this work in 2020. And it really can provide some peace of mind, but it's really more of a how-to. But what do you have to add to that?
Yeah, if you Google bucket strategy, you'll see that people say it has lower returns than just having one portfolio and rebalancing. All of that stuff is all nonsense. It all misses the point. The point of a bucket strategy is 100%. And it's to help us as human beings in an imperfect world know that we always have a certain amount of years. Again, with bonds, they're not 100% safe, and that's why we have cash. We have cash to spend right now. We have bonds and other fixed assets that we can spend in year 2 through 7 or 8. And then we have a long-term bucket that we actually say, Charlie, when markets go down, don't look at this. Don't look at this. Look at this. You have the next number of years. And a bucket strategy, that's what it does. One of the authors that I read used to say a bucket strategy was ridiculous. And then he started working with actual live human beings. And then he said, I get it. The bucket strategy is super helpful. So the difference between a bucket strategy and a one portfolio, maybe it's not huge, And maybe it'll do worse or better, but I think the point is, Charlie, is how many years of safe money do you want? And that's what a bucket
Yeah.
strategy does for you. It's different accounts for different goals, basically.
Absolutely. I use it for saving, everyday savings. I have different buckets for vacation, for Christmas, and it's kind of the similar things, except in retirement, really, it's about risk. By the way, a good resource here is Christine Benz at Morningstar. She's written a lot about this. If you're a do-it-yourselfer, go check that out.
Yeah, one of the good people, good gals in finance, really smart, well-spoken, written a lot of great articles on the bucket strategy. So, and she does actually have some bucket strategy portfolios.
Yeah.
So, talk about do it yourself. That's what she's trying to help people to be able to do it.
Absolutely. Kevin, to your point, if you do the bucket strategy, you still have to have the same portfolio allocation. You can't let it jack up your allocation. And, if you're 60-40, then you still need to be 60-40. And so that becomes a little bit more challenging. Take maybe a little bit more work if you're doing that on your own. One of the things that I think is real in the bucket strategy versus, let's say, a target date. If I'm in retirement, I'm a retiree, and 2008 or even 2022 comes along, 2022. 2020 we saw this work as well. But if I'm a retiree and I've got my money segregated into accounts, meaning cash for my immediate spending needs, 3 to 5 to 7 years, and another account, another bucket, so to speak, and then the 10 plus years, then I'm not going to sell those stocks when they're down, Kevin. That's bucket 3. I'm going to see that they're down, and I'm not going to sell them to create my income that I need. That's the big win, because sequence of return risk, which is a whole nother podcast on its own. You can Google that, whatever. That is when my investments are down the year that I retire or the first couple of years, and I start to withdraw them because I have to. I need that money. That is sequence of return risk. And because of the time value of money, that's the worst possible time to pull money out of investments is when they're down. The bucket strategy can help you prevent doing that. And I think that's a huge win in and of itself.
Yeah. I mean, I think you're exactly right. The only thing I would differ on is that if you're going to be 60-40, you're going to be 60-40. I would say by using the bucket strategy, we try to figure out how much of the portfolio should be in bonds. I mean, sometimes we meet clients, Charlie, and we say, you look like a 60-40 person. No, you look like a 70-30. No, you look like a 50-50. And you'll ask the person, what do you think? And they're like, I have no idea. That's why I've contacted you. So with the bucket strategy, you say, how many years of safe money do you want? And then you could have this much in bucket 3. That could be your stock portfolio. It could be 70 or 80% equities. Again, probably we're not going to want to do that. We're still going to want to lower it a little bit, but still that's the difference in the mindset, I think.
Absolutely. Yeah, you nailed it. Your allocation, the bond allocation is hugely important as it pertains to your immediate spending needs, your 5-year, 7-year spending needs, but also if you're 80-20 going into retirement, you're going to be shocked in 2020 or 2008 or whatever, and that could be difficult emotionally.
Yeah, Charlie, I just lost 40% of my money.
Oh, you'll be fine. Don't worry about it. No problem.
Yeah, don't worry.
Yeah, that's probably not what you will be saying, right? So
no,
there's a balancing of that. The last thing, and we probably won't elaborate too much, is just this dynamic spending guardrail approach. This is going to take some work. I'd say, again, this is the most likely or closest thing to our strategy we do for clients is just look every year, where are we? Let's run some Monte Carlo analysis. What's the reasonable likelihood of probability of success? What's the minimum probability of success that we feel comfortable with, that clients feel comfortable with? And that means a maximum spending point, Kevin. And then we kind of have to that's where the art comes in a little bit. Hey, we're talking about risk management now. And so a little bit more technical, but anything to add to that?
Yeah, so let's talk about the 4% rule again and then talk about the dynamic. So the 4% rule says that we're all lemmings and we're all going to increase our spending by the amount of inflation each year. And we know that's not true. The dynamic says, hey, we just had a really good couple of years. We think you can spend more. But the only part of the dynamic that kind of stinks is that when we have a number of bad years, we have to say you need to spend less, or you might need to spend less if you don't want to run out of money. So that's the part of the dynamic that people love, and then also the part that people hate. Charlie, what do you think?
Yeah, I think it's interesting. Most people, like to your point there, most of the time people get to increase their spending, at least with inflation, unless we have multiple years of underperformance, because one bad year is expected. The recession or downturn is expected. So we can kind of live with that. And a lot of times people will go, "Hey, we've had a bad year in the market. Do we need to change everything?" No, not unless we pulled money out of stocks that are down. Then that's a different story. But we've anticipated some downturns and whatnot. So yeah, those are some things with a dynamic spending strategy. Real quick, Kevin, before we transition into a little bit more of the planning side of things, because I know we're limited on time today, here's a couple valuable resources. You and I like the whitecodeinvestor.com. At least last time you and I talked about it, you liked it. I'm not sure opinions changed. They're pretty good. They have some really good information. I went there to check out a few of their retirement calculators that people can use if they're do-it-yourselfers. I'll throw out a couple. We'll have the link in here in the show notes, but they've talked about Projection Lab is one. Pralana, Pralana. I don't know how to pronounce that. There's another. Investor.gov, believe it or not, Kevin, a government website.
No, don't say that, Charlie.
Seriously, yeah. So pretty amazing. I received a good score from these folks. And so they go into, again, great article about which ones you can use if you are a do-it-yourselfer. It's going to take a little bit of effort and some time. If you want to do that, you can. And we've known people to do that as well. So I think it's a reliable source. Morningstar we've mentioned, White Coat Investor. I know the Bogleheads have a good reputation for being detailed and doing their own work as well.
Yeah, I'll just say this about the White Coat Investor. Everyone likes a good story. At least I like a good story, Charlie. And he was an emergency room physician, and he was appalled by the amount of salesmanship and brinksmanship in the financial markets. And he started just writing because, Willie Sutton says you go where the money is, and doctors is where a lot of financial people, as well as sharks, go after. And so he debunks a lot of the myths that we hear and really has a great channel. Yeah. So White Coat Investor, absolutely second and third that.
Yep, absolutely. And again, we know that half of you folks listening today are probably more delegators. And I think if I'm in retirement, I'm not interested in doing a lot of this myself, quite frankly. So there's some options as well. And that would be find a trusted advisor that's got good credentials and they've got some good technical skills, because this is technical. This is not just selling something. But Kevin, with that being said, as we get short on time here, here's a summary of things to think about, to stress as you enter retirement. You have to put pen to paper, spreadsheet, whatever, and go, what is it? What are our expenses currently? What will change in a year when we're retired? And you're going to have to kind of make some guesses. It's hard to know that. How much are we currently spending? That's the first spot, Kevin, that you got to start. How might that change? And then start running some stress tests. We've seen people, I think this was a great strategy. Before they retire, they will spend a few months, maybe half a year, practicing their retirement budget. I think that's a phenomenal way to do it, is just to get a feel for what that might be like.
Yeah, at least tracking for sure, Charlie. But I do want to bring up annuities before we go, though.
So, absolutely. I kind of skipped over that because I'm all fired up about this topic.
Yeah, absolutely. Yeah. So Charlie, what you just said about spreadsheets and stuff, when, people contact us all the time and they just ask us, hey, I just want a quick second opinion. They're a pilot. They're in our niche. We want to help. And the ones that have all of these fancy schmancy spreadsheets, usually I'm like, yeah, I'm impressed. But more so than being impressed is that they've at least thought through a lot of the dynamics that we think through. And I think that's the key takeaway, is to think through all of these dynamics. And don't just do it in your mind one time. Do it, actually put it down somewhere and look at it. And again, there are lots of tools out there. So I think you're exactly right. That's what planning is all about, right? It's all about thinking through all the risks and the positive outcomes. So I think the biggest issue, number one issue for people, is what do I want in retirement? And what I mean by that is, do I want to play golf or something like that? No, that's not what I'm saying. Is that you can have a lot when you have a lot of money, but it's really hard to have everything. You can't get the highest returns, have the safest portfolio, outpace your friends. Maybe you can have higher CD rates, Charlie, than some of your friends. But really, I think mission number one is decide what's most important to you. Is it being able to sleep well at night? Is it feeling a sense that you're missing out on something? And is there a way to scratch that itch, et cetera, et cetera? And then the second issue that I would ask people to consider is that as we get older, our executive function goes down. Eventually, many people are scammed that are young, but also people as they get older, it's sometimes more difficult to think through all of these complex topics. At least have a fail-safe person that you can go to. Hopefully not someone that's highly opinionated. If it's not a financial person, hopefully it's a friend that's very, very thoughtful in the way that they've thought through all of these things, because all of us slow down, we'll say, as we get older mentally. Absolutely. So yeah, I think to me, those are the big two issues: is define what you want. What's the most important things? Is it not eating cat food, not running out of money, or is it dying with the biggest portfolio? And I'd even challenge that one, but still, that might be your goal, is figuring out what your goal is and what you're willing to give up and not give up.
Yeah. It's very dynamic. I think that we've used that word a lot today. One of my fears, Kevin, is I don't want to be 85 or 90 and have more money than I did at 65. I want to be able to maximize my spending smile that we've talked about. But just a couple keys for people can take with them today as we wrap up. We've kind of bashed some of these strategies. We've got our strong opinions, but 4% rule is a starting point. Yes. And it is, for us, when we look at some calculations, we kind of go back and go, all right, like you said, hey, I'm spending 8% a year. Oh, hold on, time out. That's not going to work. So it's a good maybe reference point, if you will. The more thought you put into this, dynamic spending strategies can add resilience to your plan, to use a fancy word. And then, like you said, annuities, if you get it the right one. And by the way, Social Security is an annuity, military pension is an annuity, VA disability is an annuity. If you
don't say that, Charlie.
If you've got all that stuff, you don't need another one, in general, I should say. But they can add peace of mind, because you've seen, and I've seen in research, where people have that, if they have a good annuity, which is about 1/10 of all of that are out there, then they feel more comfortable with spending, because they have that guaranteed floor for the essentials, if you will. So, yeah. What do you think?
Yeah, so I like annuities. Yeah, I said it. I like annuities. And the reason I like them so much is because, again, the research shows that people that have an annuity, that money's kind of already carved out of their pile of money. And a lot of people, not all, but a lot of people save their whole life. And that balance gets to a certain point, they're hyper focused on it. And then when they have to spend money to get a new car, they can't do it, because then their balance goes down. An annuity is like mailbox money. For those of you that are younger, that's how we used to get paid. We used to get it in the mailbox. So you get the money in the mailbox and you have it, you spend it. So I do like having a military pension, having Social Security, because that's money that's really freely spendable emotionally to most people. But the other reason I like annuities so much is that you really can have a floor about the amount of money that's coming in, and your goals your most important goals can all be covered. So day one, you arrive to retirement, all your major goals are covered, and annuities can do that. Now, I'll just say there's a big war between non-annuity salespeople and annuity salespeople, and we don't want that. We want to be able to offer annuities to people. We don't sell them. We don't make commissions, but we want them to get them if they're appropriate. And here's the number one reason why I like annuities that goes against what everybody says. Everybody says, oh, they're not liquid. You're stuck. And what I like is to take maybe 15 or 25% of your money, put it into an annuity. You ain't going to, if you have $2 million, if you're going to spend all $2 million, Charlie, if it's all liquid and you're going to spend it, you're screwed. Mm-hmm. So if you take a small part of the annuity and you make it guaranteed income, and that's all annuities are, they're not investment vehicles. That's not hurting your liquidity. You still have the other million, whatever, and you ain't spending all of it at the same time anyway. So if it's all or nothing, yes, it's a problem. We really don't like that. Sorry, rant over.
Yeah, you got excited there. That's good.
Yeah.
But the point I think is that it's not a yes or no. It's not binary. We try to simplify these things, and it just cannot be done. But Kevin, just in summary here, you got to define some goals. You got to put pen to paper, talk to your spouse. What is it we want to do? What are your income sources? What are we spending currently? How might that change? Most of our clients don't have a budget or spending plan. We get it. I don't either. They don't have to up until you start to retire. Then you need to really know what you're spending, where it's going. Practice it before retirement is a good strategy. You have to somehow pick your poison, calculate a sustainable withdrawal rate. And then, like you said, consider some kind of guaranteed income floor to provide the essentials. If you've already got some pensions, then you might have that covered already. If not, consider some kind of very simple quality annuity. They're out there, harder to find, but they're out there. We can help. And then you have to review annually. You can't just set it and forget it. This is not one of those things that, like when we're saving, sometimes we can do that. But Kevin, that's all I got. Any closing remarks on your end?
Yeah. Unfortunately, when you retire, it's different. It's totally different. What I mean by that is when you hear news stories, when you read things, you only have so much money. It's just different. Be aware of that. Mm-hmm. Be aware it'll be different, and you'll get through it. You'll get through the first year in retirement. And a lot of retirees, Charlie, have really high satisfaction scores on studies, which we don't believe are all true. But, if you have money, retirement can be an enjoyable time of your life.
And a prelude to our next podcast, Kevin, if you have purpose. We're going to talk about that soon. That's exciting. Yeah, you have to have both. I'm just going to say it out, throw it out there right now. But hey, we love to do this stuff. For those of you that are delegators, give us a call. Email myself, charlie@leadingedgeplanning.com, kevin@leadingedgeplanning.com. If you're too shy to do that, just go info@leadingedgeplanning.com, and we will respond. And so we love to work with this stuff. It's what we love to do. You love to fly airplanes. You love to fly different kinds of airplanes. We love to work with people and help them with retirement income planning. So give us a call. We appreciate it. Kevin, last words, last remarks, anything?
Yeah. Eat, drink, and be merry, because tomorrow we die, but we can have a long retirement and hopefully enjoy it.
Amen, brother. All right. Thank you all for listening. We'll see you next time. God bless.
Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie@leadingedgeplanning.com. Again, that's Charlie@leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.